Okay, good evening, everybody. I have 6:30. Let's get started. We might have a couple more people that are hopping on during the presentation, but welcome to our Zoom call tonight. And we are talking about the big, beautiful bill and what it means for you, as this is one of the more sweeping and significant tax changes that we have seen maybe ever. And it certainly has ramifications for all of us in one form or the other. I wouldn't say radical ramifications, but there are a number of things that if they're not affecting you now, they very well might in the future. So many of you are familiar with the tax law that was passed recently. And actually, this was back on July 4th that this was signed into law where the Senate and the House agreed on the same bill, and then it was signed by the president. And it literally is the one big beautiful bill, is the way that it is known. So the question is the bill that was passed, what's in it, and what does it mean for you? There's many provisions that are in here that we're going to get into. And one of the things that I tried to put together here was some of the things or the provisions that are in the bill are things that are permanent. So unless there's new legislation that cancels some of these things out, then they will be in place forever, which the tax code is always going to change. And so some of this will maybe change over time. But there are things that are written in the bill that are designed to be permanent. And there are also things that are designed to be temporary. Many of the, or really a lot of the things that are temporary are things that have started and are enacted already in 2025, but they will expire in 2028. So as we go along, I'll attempt to, and I put these in the slides as well, to let you know which one of these things is permanent and which is temporary. Okay, now, one of the most significant things, and for some of you, these things are things that you may very well know already. Some of these things might be new to you. So hopefully we cover enough things tonight that make this worthwhile for you. But one of the most significant things about this tax bill is, and this goes back to 2017, when the more recent tax or sweeping tax code that happened that year. But one of the things that happened in that tax bill in 2017 is it changed the tax brackets. And for many of us, that meant that we were perhaps the bracket that we were in is now a lower bracket. So maybe you were in the 15% tax bracket, and then that bracket itself got moved down to 12%. Or you might have even skipped kind of a bracket in between there as well. We're not going to get into all of that, but that tax bill in 2017 had built into it that it was going to sunset in 2026. So unless something happened this year where new legislation got passed, signed by Congress and the president, then what was going to happen is many of us were going to have an automatic tax hike. Why? Because the tax code from 2017 was going to expire, and then you and I would have gone back to the tax code that was in place prior to that bill in 2017. For many of us, that might have meant that if you're in the 12% tax bracket, now you might be in the 15% tax bracket. And, there's all sorts of variations depending on what your income is. So it's funny because I did hear, or this was presented as a tax cut. I wouldn't describe the big beautiful bill as a tax cut. It prevented an automatic tax increase, is the way that I would look at that. And maybe that's just semantics. But if you like lower taxes, then right off the bat, the big beautiful bill essentially kept you from paying higher taxes almost in everybody's case starting in 2026. And yes, this is a permanent part of the tax bill. So there's inflationary adjustments to the brackets that are built in. That's always the case. But the brackets themselves, 10%, 12%, 22%, 24%, 32%, and so on, that is now in place permanently until there's other legislation that comes along in order to change that. So that's basically good news for all of us because we are not getting a tax increase, at least from that standpoint. Now, one other thing that was a part of that 2017 tax code is that our deduction system for our tax return changed kind of significantly. For many of us, we would itemize our deductions. So what does that mean? When we would itemize our deductions, things that would be deductible from our taxable income are things that we pay, such as local property taxes, also state income taxes, charitable giving is in there as well. So all those things, if you added those things up, and if you were married filing a joint tax return, I think prior to 2017, let's say basically your standard deduction was about $14,000, give or take, if memory serves correctly. So if the total of your itemized deductions, property taxes, charitable giving, some healthcare expenses, depending on your income, etc., then if that was higher than $14,000, give or take, and you were filing a joint return, then you would itemize your deductions. If the total of those things was less than the standard deduction, about $14,000, then you would take the standard deduction. All of that got kind of thrown out where now the standard deduction is considerably higher. In fact, before the big beautiful bill, if you're a joint filer this year, your standard deduction automatically was going to be $29,200. By the way, if we go back prior to 2017, there was also money that you got off for exemptions and so on. All of that just got combined into a larger standard deduction, which this year for married filing a joint return was going to be $29,200, or for single filers was going to be $14,600, give or take a little bit. So this jumped up now to $31,500 for joint filers and $15,750 for single filers. But that doesn't stop there. If you're a joint filer, now you're at $31,500. Regardless of what your itemized deductions are, you're automatically at $31,500 unless your itemized deductions are higher than that amount. But if you're over the age of 65, you can also add another $1,600. And if both of you filing a joint return are over 6,500, then you can add $3,200 to this $31,500. So really, if you're both over the age of 65, your standard deduction now this year is $34,700, unless you have itemized deductions that exceed that amount. If you're an individual filer over the age of 65, now your standard deduction is $17,350. Okay, so a lot of people now take the standard deduction. I also failed to mention one of the other big itemized deductions is interest on your mortgage. So that's included in your itemized deduction as well. Now, one other thing I wanted to mention here is these are deductions that we're talking about. These are not tax credits that we're talking about. So what's the difference? A deduction, that's not how much money you get off of your tax bill. A deduction is how much money you get off of your taxable income in order to figure out your tax bill. So if you could choose one or the other, take a tax credit because a tax credit is just simply the amount of dollars that are taken off of what you owe in taxes. That's much more valuable, but a tax deduction is valuable, just not as valuable, because a tax deduction lowers your taxable income that is used in order to figure out your tax bill itself. So a lot of what we're talking about is really the tax deduction. In other words, what gets subtracted from your taxable income in order to figure out your tax bill. Okay, so in addition to extending the current tax bracket system, another thing that is favorable is that we have bumped up the standard deduction. And this is so that what's on the screen here, about $2,300 for joint filers, and then about $1,150 for single filers. So that's how much more you can subtract from your taxable income in order to figure out your taxes. Okay, now they didn't stop there, but let me explain this. There was a lot of talk about getting rid of taxation on Social Security benefits. Many of you drawing Social Security do pay tax on your Social Security benefits, but it does depend on your overall income situation. Some of you don't pay any tax on Social Security. Some of you pay tax on 50% of your Social Security benefit, and others of you pay 85% of pay tax on 85% of your Social Security benefit, depending on your overall income situation. But that hasn't necessarily changed as part of the bill, so I'm not going to get into that. We were being told that we might not have to pay tax on any Social Security benefit. That did not happen in this bill. Now, my understanding, and you hear a lot of things, but you don't really know what's going on behind closed doors. But my understanding is it was discovered that it would not be legal to change that within the tax code system. So instead, what they did to deal with that is to give you a bonus deduction, and this is for seniors over the age of 65. Yes, I know some people can draw and do draw Social Security as early as 62. But the way they wrote this into the bill is that for people over the age of 65, you get an extra $6,000 of deduction per filer, in addition to the standard deduction that we just talked about. So on the previous slide, we talked about these deduction levels based on your tax filing status, joint or single filer. By the way, the standard deduction change was permanent. This is an extra $6,000 on top of that amount. However, if you're married filing a joint return and your income is over $150,000, then there is a phase out on this bonus deduction. We're not going to get into all of that. This is something that we can either talk individually about in person or talk about it with your tax preparer. But if you're married filing a joint return and your adjusted gross income is under $150,000, then each person over the age of 65 can take an additional $6,000 off of their taxable income in order to calculate your taxes. But if you file a single return, then this starts to phase out after $75,000. Now, this bonus deduction is temporary. So this starts this year in 2025, but unless something changes, it does expire after 2028. So what might this mean to you? If you're married filing a joint return and you're both over the age of 65 and you fall under this income level, the 150,000, and you're in the 12% tax bracket, well, then take 12% of $12,000 So what this means for you is it's about $1,440 extra in your pocket that you do not have to pay in taxes in each of these years that this is in place. Okay. If you're in the 22% tax bracket, which even if your income is bumping up against this 150,000, it's a pretty good chance you're in the 22% bracket. So now if we do the math, this could mean about $2,640 that your tax bill is lowered. So that's money in your pocket. So that's good news for you. However, if your income is above these limits, depending on your filing status, then this gets minimized or phased out altogether. So higher income earners or receivers in retirement, then this may not apply or only part of it applies. Okay. I'm not going to get in a lot into this one, but higher income receivers in retirement or even before retirement are subject to alternative minimum tax. What is alternative minimum tax? It's a tax for people that have high incomes, but also have high deductions or a lot of different tax breaks that are built in. They might be subject to alternative minimum tax to counterbalance some of that and not keep high income earners from lowering their tax bill too much. So it's kind of another way of calculating your tax for higher income earners. I'll leave it at that. So they did make a change here, and the amount of income that can be exempted under this situation. So this was changed. The exemptions were changed back in 2017. That's what the TCJA means. So we're basically just permanently putting those exemptions in place. Many of you, if you're subject to alternative minimum tax, you have a pretty good idea that you are. So this is good news for you, but again, it's really just a continuation of what's been in place since 2017, and that has been made permanent. We'll leave it at that. Okay, now there's another section I put together here called family tax benefits. And so many of you may not have children where this would apply, but you also might have grandchildren. So this is something that you can be happy for your kids and their grandchildren, because what they did here is the child tax credit. Now, this is a credit, this is not a deduction. So if you have a child in your home and basically they are under your care, your taxes would get lowered by $2,000 per child. However, the bill increased that to $2,200. So that's an extra $200 in the pocket per child for the family in that household. So if you have 4 kids, then instead of $8,000 that you would get as a child tax credit, you now get $8,800 or $2,200 times 4. The child must have a social security number at that point. This is a temporary function. So after 2028, we will revert back to $2,000, although there is automatic inflation adjustment in that, depending on what the inflation is like in the economy between now and then. But this extra $200 does go away unless they pass new legislation that extends this in the future. Now, this one took me a little bit by surprise. So there is a newborn Trump accounts feature to this. If you have a child that is born this year or any time between now and the end of 2028, the federal government is going to open a savings account for those newborns, and they're going to put $1,000 into that account. Okay. My understanding is this happens automatically. Well, how do they know that a newborn was born in order to start this account? My guess is that when the parents file or register the child with a social security number, that probably triggers this. So For newborns that don't have a social security number, I don't see them setting up this account. I'm assuming that once that social security number is registered, the federal government will automatically open up the account under that social security number, deposit $1,000 in it. Then the parents control that account where they can decide there will be investment options. They'll be all index funds inside of this account. So you can choose an S&P 500 index fund to have that money go into. My understanding is this is just one deposit of $1,000. I don't think that this is ongoing. Parents can contribute to this. They can put up to $5,000 per year into this. It's after tax money, which basically means you do not get a tax deduction for the contribution, but the money would grow without having to pay tax on it. And then after the child is age 18, this money can be pulled out for education or for some type of job training or for their first home. And the growth on the money would not be taxable. So this should not be subject to capital gains tax or any interest or dividends that are paid along the way. And if you don't use any of this money between 18 and 30, then after the age of 30, money can be pulled out and it doesn't have to be used for education. It doesn't have to be used for job training. It doesn't have to be used for a first home. You could pull the money out, use it for a car, use it for a boat, whatever you want to do, and it would still remain tax protected there. So these are not 529 plans where the money has to be used for education. But it does give earning potential because you have a series of index funds that can be chosen. And if you have a child or a grandchild born this year or anytime by the end of 2028, then I encourage whoever's responsible for this, encourage them to make sure that a social security number gets generated. And then I would think that this automatically gets triggered. I could be wrong in this getting triggered by the social security number. Maybe there will be a separate registration process. I tried to look this up and I couldn't find anything on it. All I could find is that an account will automatically be set up, but I'm sure it won't be set up without a social security number. As an aside note, I'm fascinated because my second grandchild is due to be born August 22nd. So I'm thrilled to have a second grandchild. I'm somewhat thrilled to actually watch this play out because it'll be interesting to watch it firsthand and see how all of that goes. Why is this happening? Actually, I think the reason that this is happening is that the federal government understands that population growth is important for our country, and they're encouraging young families to have children. Why? Well, frankly, over time, we're going to need more and more workers in this country, especially as our economy expands. And hopefully, if a lot of the things that the government is doing works, we're going to need more and more and more workers down the road. Europe has suffered significantly over the years because their birth rates dropped dramatically. And that has become a real problem for economies in Europe, where I think part of what this is encouraging is for families to grow and even have big families. It goes back to the tax credit that we just looked at, but also the newborn accounts to be set up. So enough on that. If you're a grandparent and you have a new grandchild in this period of time, get on the parents to make sure that they get the social security number process going as soon as possible. Okay. So what these changes could mean for you or for your children and grandchildren is basically higher refunds for families with qualifying children. This is all to support more newborns, but there are also strict qualifications for obtaining child tax credit and newborn aid. So it's good to be aware of all of that. We can help with that. Okay. Now, what about retirees and senior planning? What does all of this mean for you in retirement or for planning for retirement. The $6,000 senior tax deduction, in my mind, is pretty big. Again, it's available for seniors. You have to be 65 or older. And yes, the year that you turn 65 is when this deduction happens, which is maybe obvious, but I thought I would point that out. So there are the income limitations here, and there are phases out above these income thresholds. And so keep that in mind depending on your situation. And again, this bonus, $6,000 senior deduction bonus, is temporary unless it's made permanent in future tax legislation. So this may very well have an impact on Social Security taxation and IRMA. So what's IRMA? IRMA stands for Income Related Monthly Adjustment Amounts. So what does that mean? It means that if you get too much income in retirement, you might have to pay more premium on your Medicare benefits. So this year, a standard Medicare Part B premium is $185 and change per month per person. If you make too much money, IRMA might bump up that Medicare premium by $40 as the first level. And I'm not going to go into all the levels, but if you make a lot of money in retirement and you are subject to IRMA, you might, instead of paying $185 a month for your Medicare Part B premium, you might end up paying $400 or $500. Now, how much are we talking about here? You would have to make several hundred thousands of dollars, $500,000 for some of these real high IRMA levels to kick in. But if you are subject to IRMA, and a lot of people think, oh, that's never going to happen to me. Well, if you have a nice sized pension or two pensions in your household and two pretty nice Social Security benefits going on, plus on top of that, you get to required minimum distribution age for your IRA accounts, your 401k accounts, you might be surprised how quickly you might get to at least that first IRMA level and have your Medicare Part B premiums go up. And so this impact on the extra $6,000 for an individual or up to $12,000 extra deduction might, while you're in retirement, help to keep you away from IRMA increases. But if you're younger than 65, this might also help you to control your future required minimum distributions or being subject to IRMA. Why? Because this allows you to take more income and protect it if you're over the age of 65, so that things like IRMA or really large future required minimum distributions, which might explode your taxes for many of you starting at age 75 or 73, depending on the year that you were born. So what we're looking at so far is this extra $6,000 bonus deduction might be an opportunity to help to control some of these things in the future. Now, I'm speaking pretty vaguely because everybody's tax situation is different, especially in retirement when there's different sources of income, different levels of income. But there's potential here where that extra $6,000 or $12,000 for joint filers that we might be able to customize a strategy between 2025 and 2028 in order to take really advantage of that extra deduction and do some things that really might pay off for you down the road. In the same vein, that extra deduction might keep you from higher levels of taxation on your Social Security, or it might even keep you from paying tax on Social Security, period, again, depending on your overall situation. So the things to consider here moving forward is if you've been doing Roth conversion, getting money from your traditional IRAs or your taxable 401ks, into Roth, where then money is tax-free the rest of your life. And the thing about Roths is you don't have required minimum distributions on them. So if you're doing, and I talk to a lot of you about this, if you're doing Roth conversions, the extra $6,000 for an individual or $12,000 for joint filers might be a reason to accelerate your Roth conversion strategy. Let's talk about that and see if that might be something for you to look at. Also, even if you're not doing Roth conversion, maybe taking more money out of your taxable accounts, your traditional IRAs, your taxable 401ks, maybe even taking out more money now because you're protected with the $6,000 for single filers, $12,000 for joint filers. So you might actually be able to get some money out of those taxable accounts, even tax-free. That's something to look at. Required minimum distributions. It's kind of the same idea where don't wait until you're 75, if that's when your RMD age is, where you're forced to take money out of those taxable accounts. Maybe start doing that now prior to when you're required to do it because you have an extra tax cushion between 2025 and 2028. Now, again, as I'm talking, you might wonder if this is applicable to you or not. We need to talk about that. We need to simulate it. And the way that we do that is for many of you, we have recent tax returns on file for readings like this, or we'll have you bring in your tax return and we'll look at this and apply all of the things we're talking about tonight to your tax situation for 2025 and then figure out what might be meaningful for you. So, basically, when we talk about tax brackets, all of these things affect your Medicare. It affects your modified adjusted gross income on your tax return. It affects your marginal tax brackets. It affects your deductions. It might lower your taxable income. I put on here, if your modified adjusted gross income goes $1 above the IRMA threshold, in other words, if you're just $1 in too much income, and that might, if you're just $1 over, automatically you're in that extra bracket for your Medicare premium, and those stakes are then pretty high, bringing you a higher premium and in that bracket affecting a number of things. So it's important that we look at this. Okay, moving on. Estate and wealth transfer. One of the more significant things is that they raised the federal estate tax exemption to $15 million per person. So, okay, what does this mean? When you die, there might be income tax ramifications for your beneficiaries. Let's say you have a traditional IRA account and you list your kids as beneficiaries. That goes to them, but they have to empty that out within 10 years and pay tax on that money in their tax bracket. And so, that's a tax ramification for them. So when you die, there might be some income tax ramifications for your beneficiaries. That's not what we're talking about here. What we're talking about is not income tax, but actual estate tax. Or in other words, when you die, there's another type of tax that you might be subject to. The good news is that if you die, you can protect the first $15 million of your estate. Now, it was 13.61 million. So they upped that to 15 million, and that's per person if you're married. So it's really, as you're married, you can exempt up to $30 million now. What all goes into that? It's the equity in your home, life insurance proceeds gets added to this, your retirement accounts, your bank accounts, your cars, your other valuables, anything that really is of worth when you die, including your life insurance proceeds, goes to your estate calculation. But if you're married, filing a joint return, you can exempt up to $30 million now instead of 26 million. So when I first started in this industry, and yes, I'm this old, That was 27 years ago. The exemption was only $600,000. So anything above 600,000 in your estate was going to be subject to estate tax. And I think at the time the state tax started at 40%. They have now been raising this considerably over time and even did it more in this bill to get this up to $13 million per person. And it also does go up every year because it's indexed for inflation going forward. So this is good news for estate tax planning, although you already were exempting 13.61 million. By the way, if we didn't pass this bill, this $13.61 million exemption was going to go back to the pre 2017 numbers, which would have been probably after index for inflation would have been about $7 million. So this is good news, especially for people with estates of this size. And again, this is permanent. So there is no reverting back to prior to 2017 numbers. And this will just keep going with inflation over time. Okay. So who benefits? Basically, if you have an estate under $15 million, there's little that is really changing here. For people with estates over $15 million, you are still subject to tax. But if you're married, then this can double to $30 million. So you still a lot of protection there. Estate tax especially has been hard for business owners and farmers because when the exemption was only $600,000, and you might not have if you're a farmer and you might not have a lot of other assets. So you know the estate tax exemption of 600,000 maybe was not all that threatening, but your land might have been worth $10 million. So what was happening is when the estate tax exemption was only 600,000, farmers were having to sell off at least part of their land or all of their land in order to pay this tax bill. And so that's why they've been raising these numbers considerably over time. And probably in part two, because a lot of this money's been taxed already from income tax. And so to tax it again when you die became unfavorable in Washington, and that's why they keep raising these estate tax numbers. So I'm going to stop with that because you know, many of us, this is not really a consideration, but at least it's good to be aware of because if this changed, then it might actually affect some of you, but they did make this permanent, and so that's good news. Now, kind of in the same vein here, many of you know that when you gift money to an individual, the first now it's the first 19,000. I think last year, what was it, 17,000 that you could protect. So they bumped this up as well. So to exempt you from paying estate tax, the first $19,000 of a gift per person is exempt from gift tax. It's still good to declare the gift because there is tracking on that over time, especially if a lifetime exemption is needed, but we won't get into all that. So again, good news if you're gifting money to children or grandchildren, you have extra money that you can gift without being subject to gift tax. And yes, the gifter has to pay the gift tax, not the receiver of the gift. Okay. Estate planning in a shifting landscape. Yeah, a couple of warnings here. If we were going back to the old pre 2017 code where the exemption would have been cut in half instead of going up to $15 million, then there would have been a whole new generation of people that had to do planning according to that. But again, because of this exemption, that relieves a lot of you from doing that. The other thing about this is there are many states that have estate taxes that have much lower thresholds or exemptions than the $15 million. Almost all of you, I think, who are listening to this are state of Wisconsin residents. The state of Wisconsin does not have estate taxes. In large part because there's a lot of farmers here, and so the state doesn't want to have to see people sell off their farms just to be able to pay estate taxes. Okay. It is possible that all of this could change in the future, although I would say there's been a lot of hikes from the 600,000 exemption 25 to 30 years ago to this $15 million. That seems like this is more of a progression where we're kind of getting rid of the estate tax altogether. Okay, now a couple other things here, and then we'll wrap up. There is something else that might affect a number of you, and you might have been hearing the term SALT. So SALT stands for state and local tax deductions. If you are itemizing your taxes, which means that you're adding in interest off of your mortgage, the taxes that you pay for state, the taxes that you pay for your real estate tax on your home, maybe some federal or healthcare expenses. When you add all that up and you are itemizing instead of taking the standard deduction, there was a cap on how much state and local tax you could deduct. It was $10,000. They bumped that up to $40,000. This applies to incomes under 500,000, so there is a cap, and then it phases out gradually above that. So if this applies to you, then basically you can now take more of this tax, state and local, and add it to your itemized deductions for the sake of your tax calculation. This is a temporary thing. So unless something happens, this will expire at the end of 2028. Basically, if you're taking the standard deduction, which about 90% of us now are, then this isn't all that big of a deal. Tips, this was certainly a campaign issue and also talked about. This did make its way into the big beautiful bill. So for people that are earning tips and overtime wages, they are exempt from federal income tax. But again, this is temporary. So that starts in 2026. My understanding is it didn't start already in 2025. It goes through 2028. On the tip side, there, I believe, is a $25,000 total cap, not just tips, but a total income cap. So if you're making more than 25,000, which might be part tips, part other income, then it phases out as well. So this is a little bit of a fizzle here on the tips. But you can, there is some tax relief there, but not 100%. Okay, also, this is a little bit of a surprise too. If you buy a vehicle between the year 2025 and 2028, which again means that this rule is temporary, you can deduct your loan interest, but this is only on American-made cars. Okay. Now, I think it's a little bit of a gray area because Toyota is certainly a foreign car manufacturer, but a lot of the cars that Toyota makes are made here in the US. They've got, amazing plants in Kentucky, Tennessee, other places. So I'm not sure I have an answer to that. I'm guessing that that would not apply even though they're made in the US. Although actually, as I say that, maybe it would apply if if it's assembled on US soil, then maybe this does apply. If you buy a Ford made in this country, it does apply. However, again, for individuals making over $100,000, there's a phase out here. And so not all of that interest would be deducted, but a little bit of a break here and an incentive to buy American. And so this is something that could apply to you. The other thing that I couldn't find out is when you say the word deduction, does this mean that this only applies if you are itemizing your deductions as opposed to taking the standard deduction? I couldn't find that definitively. And part of this we'll learn as the 2025 1040 forms become available. And we can actually see how all of this is laid out on the new tax returns, but we don't have that yet. My assumption is you do not have to be itemizing deductions in order to get this loan interest deduction, but I'm not positive on that. It wouldn't make sense to me when 90% of the people take the standard deduction to offer this. I'm assuming that this is a deduction on top of the standard deduction, but don't hold me to that because that kind of remains to be seen yet. So good news there as well. Okay, now I'm skipping over a bunch of other things. This isn't all, what was it, 900 pages of the big, beautiful bill. I'm skipping over a lot of things because there's a lot in there, especially for business owners and other things. But so I'm leaving all of that out because a lot of that doesn't apply to many people that are listening to this. But it's certainly something that if you have questions on that, we can talk about more in particular. Now, there is some interesting information out there is okay, we're giving a lot of kind of tax cut or deductions or, various things here. What is this going to do to our, government revenue and so on? I will put in here that the Congressional Budget Office put a projection that this bill will cost about $2.4 trillion in new debt over the next 10 years. However, in all due respect to the Congressional Budget Office, um, many of the projections don't necessarily come true. So we'll see how all of this plays out, but I thought it was worthy enough to note and put in the presentation. So if that's true, then this could be a $4 trillion increase. Well, it includes a $4 trillion increase in the debt ceiling. One thing that I want to mention though, is while this is passed, keep in mind that so far, I think the amount of money that the federal government has taken in this year because of the tariffs is about $150 billion. Okay, well, 150 billion is small compared to the 2.4 trillion. Well, keep in mind, 2.4 trillion is over 10 years, and yet we've taken in $150 billion in new revenue so far due to the tariff situation. So extend that out over 10 years, then the tariffs would pay for all of this. However, the tariffs that we're charging now are not going to stay in place. We're charging quite a bit now as part of the negotiation with a lot of countries in order to settle on something that will be new revenue for us, but actually the big beautiful bill is gonna cost us some money over time as well. So just thought that might be of interest there too. So final guidance on all of this. What can you do now? I already alluded to it. We have software where a lot of the big beautiful bill has already been programmed into the software. And many of you are familiar with this already. We take your tax return from 2024, we scan it into our software so that now the software fully understands your tax situation from 2024. Then in 2025, we make any adjustments. Maybe you retired and you don't have wages anymore, so we wipe that out for 2025, but you might be turning your Social Security on this year. So we can make all of those adjustments on top of your 2024 taxes to project your 2025 situation. Then we can compare it to, if you're interested, we can compare it to what your tax situation would have been prior to the passing of the big beautiful bill, and then now what your tax situation looks like under the big beautiful bill. That maybe doesn't change anything, but it might be interesting to know what it's actually doing for you. But then further, when we look at things like that extra $6,000 per person as a deduction, a standard deduction, what strategies might we be able to utilize in your situation now that we can protect up to $12,000 of income? How might we want to utilize that with things like Roth conversion or taking taxable money earlier before that $12,000 runs out after 2020. I mean, there's a number of things that we can look at there. It all starts with looking at your most recent tax return and then creating scenarios and various things from there. all as a way to evaluate your deductions, your credits, even your estate issues, in order to also keep your beneficiaries in mind. Now, I'm not a licensed tax advisor. I do try to keep very knowledgeable of the tax code. If you have a licensed tax advisor, certainly talk about this stuff with them before the end of this year, because they might also have some direction for you on this as well. The bottom line, let's review your plan together. Are you taking advantage of the current opportunities? Are you protected against future risks of how this might change in the future? And we can talk about that. It's important to stay informed and stay proactive when it comes to tax law. So let's keep revisiting some of these strategies and being proactive along the way. So that covers a lot of what I wanted to do. I'll emphasize again, we didn't cover everything that we could, but a lot of what I didn't cover is not necessarily applicable to many of you, but we can cover them if you want to get into that. I do see one question here. And this participant says they're concerned about this bill substantially raising the national debt to a point of becoming unsustainable. So I covered this a little bit, but this is a really good question. Now, I don't want to pretend to talk for anybody that voted for this bill, but I will say, in listening to him, our very own Ron Johnson in the state of Wisconsin, our senator, who's been in Washington for a while now, he did vote for this bill, but he also publicly raised a lot of concerns about it. And this is in an area that he had some concern. Now, I pointed out already that even though we're not going to raise government revenue by $150 billion from tariffs, because some countries we're charging over 100% tariffs right now, that's not going to continue. However, when you look at some of the recent trade deals that have been mentioned with Japan, with the European Union, we on average only charge the rest of the world about 3.5% in tariffs. However, some of these new trade deals have about 15% tariffs built into them that will be charging other countries. That's still lower than what they've been charging the United States. And so part of these deals is we are raising our tariff revenue, but they're bringing down their tariffs that they're charging us, all with the intention of creating more of a free trade environment, literally throughout the world. Now, we don't get involved with what other countries are charging other countries. We are talking about dealing with the tariffs as it relates to the United States in particular. So what I'm getting at here is I believe that this is part of a plan where the federal government is recognizing new revenue in this new tariff environment, that even though it's a part of a free trade, we still are charging more tariffs than we have been, and other countries are lowering their tariffs. So what does that do? That makes new revenue to help to pay for this, the big beautiful bill, and the economic activity that is designed to come out of these trade deals is supposed to be, there's going to be more incentive now more than ever for even foreign countries to build plants here in the United States. Why? Because that's a way to get around the tariff. Okay, well, why would we let them do that? Because that's a lot of new jobs in this country and foreign investment in this country. Those jobs and that economic activity and that revenue for those companies that create more revenue again here in the United States for the government helps to pay for all of this. So I'm not representing that all of this is going to work. I'm trying to represent what I think is going on. And so for this good question about, we need to be thinking about lowering our national debt, not about raising it. I do believe that all of this is in conjunction with the tariff situation, with the economic stimulus that we're expecting out of all of this, and that will help to pay for this. Actually, I think the vision is that tariffs are a bigger part of our tax revenue, and that might actually mean that we lower income taxes in the future, which when we lower income taxes, it does create economic activity, which then actually increases government revenue instead of decreases it. So now I'm throwing a little bit of opinion, but that's I've studied that and that's factual as well. So I do believe there's a greater plan here, and a lot of this fits together, and it's all as a way to hopefully bring down government debt, even though the bill is going to be reducing some revenue, but it's being made up in other places. So those are my comments. I'll leave it at that. If you want to argue with me on that, I think it's an interesting discussion. But I would say, in light of everything that's going on, hopefully we're going to see a reduction in government debt in the near future, but that remains to be seen. Okay. I don't see any other questions as having come in. So hopefully this was helpful for you. Feel free to reach out to me as we meet in the future. Again, we'll be happy if we don't already have your 2004 tax return to apply a lot of what we talked about tonight to your 2025 and beyond planning. And I think those will be some helpful discussions for you. So I look forward to talking with all of you soon. That's what I have for tonight. Hopefully, this was helpful, and have a great night. And I will talk to all of you in the near future. Thanks for attending tonight.